Hey traders, this is Blake Morrow with Traders Summit, and it's Friday, and I have Mr. Jim Welsh of Macro Tides. He's with us as always on Fridays, and I love talking to you, especially on weeks like this week. Jim, how are you doing? What a week!
We're doing good. I hope you're doing okay. The one thing I'll say to people who are tuning in, thank you, but we're going to cover a lot of ground today and a lot of stuff about the stock market. So I think this is one of those videos that's going to be instructional as well as informative, because some of the things that I look at from an analysis point of view, we're going to dive into, and normally we don't really have a reason to, but I think given where markets are at right now, we need to.
Yeah, and Jim, well, first of all, for those of you listening in, if you love these videos from Jim, make sure you give him a thumbs up right now and subscribe to this channel so you don't miss any of this exclusive content. Subscribe doesn't cost anything to do. You just click the little button down below, subscribe, hit the bell icon. You're notified every Friday when these come out, and via YouTube. So make sure you do that. But Jim, you brought a chart pack with us and you want to move through it. But before we do that, just real quick, and I don't know if you go through this in your charts.
Yeah.
What are your thoughts on the FOMC walking away from that? Wasn't it a little weird how Fed Chair Powell is like, did you update your dots after CPI? And he's like, well, I think we gave them the opportunity, but not sure if they did or didn't. Wasn't that a weird answer?
I think on one level, yes. On the other hand, I don't think so, because I think he's kind of focusing on other things. One thing that came out last December, like, remember, we had a CPI and a PPI right as they were having that December meeting, and both those numbers came in really weak and soft. And a number of people did update their forecasts, their dot plot, I should say, at that meeting that morning. All right. So it happens. I don't know that he keeps tabs on, okay, let's have a hand count here. How many people? It's secondary.
That's a great explanation. And I hadn't heard that. And that's a great reminder that this was the case the last meeting.
I made a big deal out of it last December, because I thought that, because everyone, Powell did a 180, he shifted policy. And my point was, no, he didn't. And there's still people saying this, by the way. But if you read his statement was identical to the prior meeting, virtually. And I think he was just surprised by the range in the dot plots. Remember, at the December meeting, they were 100 basis points from high to low. At this meeting, 50 basis points. So those weak CPI and PPI numbers last December for the month of November, I think swayed opinion. In Monday's weekly technical review, what I said, it definitely is going to go from 4.6, which is where it was for the Fed's rate at the end of 24 in March, to 4.9. I said the market will like 4.9 because it kind of implies two cuts and that the Fed's bias. If it's 5.1, they're not going to like it. And I really thought there was a real risk of that because of just the statements that a lot of the FOMC members have made. So to me, this is the way it's broken. And on the surface, in terms of the equity market, it looks like, hey, the market doesn't care. But we're going to discuss some things to show, there is a lot of care going on. It's just not as visible as what the S&P itself is doing.
Well, Jim, let's go ahead and get into it, and let's get into those charts that you brought. And I thank you for that explanation. Really appreciate that. So the first chart that you brought, explain it to us, because I have not gone through these.
Yep. Okay, so there's two surveys. The establishment survey, which is of businesses. That's where they say, okay, this is how many jobs got created. So in the month of May, the establishment survey said 272,000. The household survey surveys houses, and it's more volatile. And in May, the household survey said, no, we lost 400,000 jobs. But so you can't look at any 1 month. And so what this is, a 3-month moving average of the annual change in job growth in each of the surveys. So on the left, hard to read, but the establishment survey is up 1.8%, which represents about 2.7 million jobs. And the household survey is at a minus 0.2%. In other words, job losses. Historically, whenever you get this big of a divergence, you're at an inflection point in the economy. At least that's what happened prior to the 2001 recession and the 2008 recession. So this is a point I've been making, that this divergence in these surveys imply we're going to see weaker job number. Eventually, the establishment survey is going to catch up, and at some point in time, the Labor Department is going to revise those numbers. All right, this is a great quote I saw, and I just thought, okay, fact that a great many people believe something is no guarantee of its truth. If this isn't true about the stock market, more so than just about anything else. Remember, in December, we were going to get 6 rate cuts. About 6 weeks ago, people were worried about a rate hike. Now we're back to 2 cuts because of the good CPI. And so to me, I always want to be a contrarian. When there's a lopsided view, either positive or negative on any market, it's time to start looking the other way, but you need substance for it. So right now, we have artificial intelligence is dominating everything. Is it important? Absolutely. Ultimately, is it being overpriced? I think so. But until we reach a tipping point, one has to also respect that when you had crowd psychology running rampant, you got to respect it. You don't want to get run over
Yeah.
by a bunch of, even if they're wrong, ultimately going to be wrong in the short run, that would be painful,
Yeah.
So
I think many people are feeling pain right now. I mean, how many people are buying puts on Nvidia and Apple, and so there's the pain, right?
There is definitely pain there.
There is the pain. So basically, it'll matter at some point.
It'll matter a lot at some point.
Yeah. All right. Well,
we're not there.
Macro will matter at some point. That's what Jim's saying. All right.
Oh, no, man, it always matters. Okay. So the other thing about the jobs, okay, everybody's enamored. 272,000 labor market so strong, blah, 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 blah. We don't have to worry about a recession. All right. Well, if you look at the unemployment rate, going back since 1945, whenever it has increased by 0.6%, which it has done, April of last year was 3.4, now it's 4%. There's been a recession. All right. Now we can talk about, geez, so many things are different in this business cycle. Absolutely. You and I have discussed them repeatedly over the last many months. But my point is, these are the numbers that are under the surface. Most people aren't paying attention to. They're paying attention to 272,000 jobs. And so this is the kind of data that, again, the consensus is no recession. This data argues, folks, you better get your guard up.
And, I have to say, this isn't, you're not the first person that I've heard this week talk about this, but it is worth noting. It's a big deal.
Yeah. And, it's not like, in my view, the employment rate's going to go down from here. It will continue to do what it's been doing, creeping higher, which is kind of like the frog in the pot, right? You turn the water temperature goes up, it's gradual, and then finally, obviously, the frog is in bad shape. That's what's happening, and I think it's lulled people to sleep a little bit. It's just creeping up. Well, that happens prior to every recession, Blake, and then all of a sudden, the economy hits a noticeable downshift, and the unemployment rate jumps. I think, again, by the end of this year, especially next year, we're going to see the unemployment rate comfortably above 4%.
All right. Well, the next chart that you brought is the FOMC. This is the shift that people are talking about.
Yeah. So in March, at the very bottom line, you see 4.6. Everyone was excited in March because that implied still 3 rate cuts. Go from 537 down to 546, 3 rate cuts. And as I noted in my Monday letter, I said, it's definitely going to 4.9. And there's a real chance it could go to 5.1. 4.9, everyone's going to be happy because that means, still we're going to get 2 cuts. That shows the bias. 5.1, a lot less happy. I also said the other numbers weren't going to change very much. And if you look at GDP, 2.1 versus 2.1, unemployment rate 4.0, 4.0. I mean, the only thing they ticked up was PC inflation, which is a little ironic. But part of that is Powell in the last press conference noted that the takeaway values from July to December for the PCE from 2023 are relatively low. And this is just an acknowledgement that the reverse base effects are going to lift PCE inflation. That's why that change is in there. it seems incongruous. It doesn't seem in agreement with, if you will, the other stuff, but that's why they're doing it. So,
All right.
anyway,
All
quick,
right.
just
Well,
to show that not everybody gets to see this dot plot thing, or I should say the summary of economic projections.
and it's so exciting. Believe me,
It
so
is.
exciting.
I know.
So
I know.
exciting.
I mean, I look forward to that every 3 months.
Me too.
Okay,
Me too.
so the dollar. We're at an interesting place here in that we've seen, the CPI came out, the dollar dipped to 104.26. And then, the summary of economic projections said, oh, we're only going to do one cut. Dollar reversed pretty hard on Wednesday. Then the news coming out of France in their election, has weakened the euro. And so we've gotten additional strength. The thing I will point out is that I think for me, it's too early to turn positive and bullish the dollar. I'm still of the mind that we're going to see the dollar drop below 104 again, below 103 in all likelihood. And there's a pattern where you can say, okay, you had this decline to 104.08, A, B, and now we're doing an ABC up here. And the targets, as I've listed, 105.97 is a 786 retracement. And then you rallied from what, 103.99 to 104, about 105.46. So 147, you add it to the low at the intraday low, 104.26, and you get 105.73. The high today was, I think, right around 80, 81 maybe. So my point, Blake, is this dollar strength or is this euro weakness? And I think one has to acknowledge that some of what's happening with the dollar is response to euro weakness.
Oh, I would 100% agree with that. But then the flip side is, given the fact that we're supposed to be cutting rates maybe 3 times this year, and that's shifted to maybe 1.
Yep.
I mean, isn't that going to lend the dollar a little bit of support as well? Despite the
it did. Look at Blake. I mean, look at how it snapped back off that intraday low after the CPI report.
Yeah.
So it definitely responded to the Fed's adjustment in terms of the Fed funds outlook. No question about it. To me, the break point obviously is that red trend line.
Yeah.
I mean, it's kind of like, okay, we're doing this big sideways chop, which again looks like a triangle. And potentially, we're still in that triangle. And triangles are a pain in the butt because they're choppy and the pattern just keeps going on, which seems like forever, So anyway,
it is very, very, it's hard. And I look, I'm with you. I mean, as far as the dollar being very choppy, I'm still trying to wrap my head around how I want to play it. But I will say that the euro is trading exceptionally weak due to all these political risks, and that is weighing on the euro, which in turn is keeping the dollar very well supported.
Well, the euro is 57.6% of the dollar index.
Yep.
So as the euro goes, so does the dollar.
Right. Well, the next chart you have is gold. Gold continues to hold the support pretty well. I keep wondering if it's a double top, but it's holding support. So maybe it's just a range.
I had thought that we were going to see a dip below 2281. It got down to 2288 intraday. You can kind of say, okay, that's an ABC down from 2249. We're off to the races. I would say that there's the potential from this recent low. A up, B down. Gold could rally. I think it was $51 from 2288. The low was at what, 2297. You had 51. That's 2349-ish. And there were off to the left before that high at 2387. There were a number of days where gold traded up to like 2360, 61, 62. So to me, it's kind of like, okay, you've got the retracement and those levels, I think, to monitor. So until gold trades above 2363, my bias is still we're going to see another drop. But again, it's possible the low is in. I just think gold has to prove itself.
All right. Well, it sure does. And you look at gold and silver and they're struggling near support, but they're still holding regardless.
Yeah.
Now, one of the markets that's been very impressive is TLT. So, and I know you have much higher targets in TLT, and it
Yep.
looks like a breakaway now. So what do
Well,
we do here?
again, the idea was that 87.34 was the end of the correction from the 100.57 off in the upper left-hand corner there. So wave A up off the October low last year at 82.42 to 100.57 down to 87.34. The take has been, I think we're beginning a wave C that would take TLT above the 100.57. And I think potentially to 105, 109. And the pattern after last week's, employment report, somebody asked me, well, have you changed your opinion? I said, no, you can make a case for 1, 2, 1, 2, and it should really start to motor. So far, it's kind of doing what it needed to do. So now you can raise your stop, I think, if you're long, and you should be, from that 88.66. That's the number I cited last week. I think you can raise your stop now to 90.65. And I was recommending people buy TLT 91 and just below. So in a sense, we've got a really nice tight stop on a position. And I think the upside is more likely. And in a way, think about it, Blake. The Fed is higher for longer. That's not going to do the economy any wonders.
Yeah.
Not going to help. And that's why we're going to get into some of the stock stuff.
Well, yeah, and before we go there, I mean, yeah, I was having conversation with our mutual friend Dale Pinkert today, and he's like, "Oh, are we going to see the bond market rally and maybe some risk aversion like old times, and maybe like olden days, like the olden days? You remember those, Jim?
You mean the guys with the gray hair? Remember that?
Yeah, I'm actually looking at one right now.
Thank you very much. I
Boom,
resemble them.
boom. All right. Sorry,
Yeah,
Jim. I had to
bada
say
bing.
it. You walked into
Okay,
that one.
so
All right.
here's the thing. Okay, I have a high-low indicator on the S&P. How many stocks are making new highs every day? How many new lows? And the idea in a healthy market, you get more new highs than new lows. And so this is a net number, and then turned into a percentage because it's divided by how many stocks are up and down. All right. So you can see how the S&P, if you look off to the left-hand side, how when it's trending down, it's usually not good for stock prices. And it's kind of a short-term timing indicator in the sense that, yeah, it turns positive to catch some bounces. Off the low last October, you can see how strong it was. Then it weakened in early December or January, pardon me. The S&P went kind of sideways. Then it worked its way zigzag up into March. And at the most recent high in May, you can see it diverged. It was hitting lower highs. Well, it's interesting in March, Blake, broad market averages like the value line, the S&P equal weight, the 500 equal weight, the Russell 2000, all peaked in March. So you had the correction in April. Then we've had this recent rally and in May, and made a lower high. And now you can see in the last 3 weeks, the S&P has been grinding its way higher. And yet there's more stocks making new lows than new highs fairly consistently. So what this says is, hey, this is a trend following indicator, and the underlying trend is weakening while the S&P is going up. And what I hope you can see from looking at this chart is normally they work kind of together. Both go up together, both go down together. So this is an anomaly in the normal pattern. And the next chart is looking at the advanced decline line. And I put a lot of weight on the advanced decline line. Again, it's a simple concept. When more stocks are going up every day than down, the advanced decline line goes up. It's just a running total of what's happening every day. Off the low last October, you can see the advanced decline line rallied smartly in December, had a little pullback, and then, much like the high-low indicator, kept grinding its way higher into March. As I noted, the Russell value line equal weight all top then. We had that correction into April, but the advanced decline line made a new high in May. But look what's happened in the last 3-4 weeks. The S&P's up, but the average stock and the majority of stocks have not participated And in fact, the last 2 weeks or so, more stocks are going down than going up. Now, that isn't a good thing. So at the second line at the top of the chart, you see, well, in January 22, you had a divergence between the AD line versus its high in November of 21. October 2007, well, the S&P made a new high, but the AD line peaked in June. March 2000, same thing. August of 98, AD line peaked, I believe it was in March, maybe. July 19. I mean, in other words, all these are sites in this instances where the AD line diverged, and then a good reason showed up to sell, and you got major declines. I mean, all these are preceding declines of 20% or more. So the question comes down to, are we going to get a good reason to sell? And so the point I would make is that if you look at the economically sensitive cyclical sectors, basic materials, industrials, the small caps, mid caps, they're all been weakening pretty significantly in the last 3-4 weeks, which is why the AD line has gone down. And again, I think higher for longer is going to continue to wear down on the economy. The unemployment data that we went through earlier suggests that the labor market isn't nearly as strong as the top line numbers suggest. So the reason to sell, in my view, is the economy at some point in time between now and year end, Blake, slows more than people are expecting. And that could provide a good reason. If short of a good reason, hey, this divergence is negative. In the next chart, well, I think, introduce, well, when can we really expect it? So the only thing going up, I shouldn't say only thing, but besides NVIDIA and all the semiconductors. So what you look at, you go back to the left side, that's March and April. And so the semiconductor, this is the semiconductor SMH, and you can see it started to, kind of go sideways. And then once it broke down is when the S&P, most of the decline in the S&P occurred. The drop was about 5.7% on the S&P. So, I took a small short position yesterday in the S&P. I am looking to add to that when I see that the semiconductor index is starting to roll over. And so the red line is a 5-period exponential. This is a 2-hour chart. The green is 13, the blue is a 21. So, if you look back in April, you can see how those things just all rolled over. And once we broke chart support, the SMH got hit pretty good. We're not there yet. I mean, you might get a V shape here. It's possible, but more likely we'll see some chopping around. And as long as SMH keeps powering higher, the weight of NVIDIA and other mega cap stocks, like you noted, Apple, and I think it's up 13% in 3 days. That's a big move for a big cap weighted stock. These things are suspending the market. I looked at the Russell 2000. It's down 3% from where it was at the end of last year. So the broad market is taking it on the chin. But if you just look at the S&P, it looks like, wow, the market doesn't seem to care about that the Fed is going to be higher for longer.
Right.
Well, somebody's caring, and they're selling cyclical stocks. So the whole idea that, we weren't going to have a recession and so forth, to me, what's happening under the surface looks like more and more people are looking at Fed keeps the funds rate where it is for longer. The economy is going to slow. Then it's just a question of how much. So,
well, Jim, it's a scary thing, but I guess the comment I wanted to make is things can go on, and the famous saying of the market can stay irrational longer than you can stay solvent. I mean,
right.
This circus act or this kabuki theater or this the game of musical chairs, the music's still playing. There may only be one chair and two people circling it, but the music's still playing. And while that's happening and they've got the band on top of the Titanic, going.
We should be dancing, maybe.
Yeah, we should be dancing. I mean, but there are risks. Obviously, you're pointing out the risks, and everybody should be aware of them because we might be at that cusp and that precipice where that tipping point. But I guess you don't know until after you've been there, right?
Well, that's why you have to look at price indicators. Like I said, okay, the semiconductors are obviously the doorway that everyone is trying to get through going in. So until that really weakens, we're going to have this status quo of what's been happening the last 3-4 weeks. But once that weakens, then it comes down to, all right, they start taking money out of the semiconductors. Are they going to reverse and buy cyclical stocks? It's possible. I think it's becoming less and less likely the longer the Fed holds the funds rate where it's at.
Yeah, I mean, rotation is different than liquidation, right?
Yeah, yeah. And one thing, just as an aside, I'm doing a little preliminary work for the July macro tides, and one of the things is going to address the point that you just kind of touched on about, hey, the market keep doing this for a while. The advanced decline line is a terrific indicator, but in the second half of '99 and early 2000, the advanced decline line was going down because everything other than technology was getting sold back then. And the tech weight of XLK, which is the ETF, technology, I think, got up to about 33% of the S&P. So as technology kept going up into March of 2000, the advanced decline line just kept going down because it's like, well, we don't need those cyclical stocks.
Right.
We're going to just have this. So it went on for months. And that's why, to your point, that the market can continue to do this longer than one would expect. My assumption here is at some point in time, those stocks are going to have a breather. And that's how you get a 5 to 7% pullback in the S&P, as those stocks take a breather and the rest of the market isn't able to offset that the selling from that area.
Well, I know there's people that want to read your technical review. So how do they do so, Jim?
Send an email, jimwelshmacro@gmail. Go to the website, macrotides.com. And no, this is a point in time, Blake, that I think looking under the surface is really important. I mean, when you're in the middle of a move, both up and down, it's kind of like, okay, everything's kind of in gear. And what we talked about last week is the S&P is making higher highs, but now you have the New York Composite not confirming, in addition to the value line and these other averages. And it's like the cylinders in an engine. If you have 6-8 cylinder all working together, great. But when they stop working together, you got a problem. That's what's going on right now. It's usually a pretty good warning of at least a 5 to 7% pullback.
All right, Jim. Well, I appreciate your commentary every week, and I know people here listening do as well. And if you do, make sure you give Jim a big thumbs up. And Jim, I want to wish you a wonderful weekend. I look forward to speaking with you next week.
Stay cool, buddy.
It's a hot one here. You do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.